Now speaking, David Coleman, Senior Director, Investor Relations. Good morning everyone and thank you for joining us for Halliburton's second quarter 2023 earnings call. We are pleased to report that our second quarter results exceeded expectations, with revenue of $7.2 billion and net income of $1.2 billion. Our operating margin was 17.3%, up from 16.2% in the first quarter. We also achieved a record backlog of $20.5 billion, up from $19.2 billion in the first quarter. We are encouraged by the strong performance of our North American business, which saw revenue increase by 8% compared to the first quarter. We are also pleased with our international business, which saw revenue increase by 4% compared to the first quarter. We remain focused on driving operational excellence and cost discipline across our business, and we are confident that our strategy will continue to deliver strong results. We look forward to continuing to serve our customers and create value for our shareholders. Now speaking, Jeff Miller, Chairman, President, and Chief Executive Officer. Good morning, everyone. In the second quarter, Halliburton delivered strong results driven by service quality, outstanding execution, and strong global demand for high-quality and high-performance oilfield services. Total company revenue increased 14% year-over-year and operating income grew 41% compared to second quarter of 2022 adjusted operating income. International revenue grew 17% year-over-year with strong activity in all markets, and North America revenue grew 11% year-over-year. Our completion and production division revenue grew 19% year-over-year, while margins expanded by 320 basis points. Our drilling and evaluation division revenue grew 7% year-over-year, while margins expanded nearly 300 basis points. We generated $1.1 billion of cash from operations, $798 million of free cash flow, and repurchased approximately $250 million worth of shares during the quarter. Demand for oil and gas is strong, as demonstrated by demand growth of 2 million barrels per day in the first half of the year compared to the same period last year. Oil and gas continues to demonstrate its critical role in the global economy, and meeting long-term demand requires sustained capital investment. Commodity prices remain attractive. Customers are settling in for a long-duration upcycle, and I expect upstream spending to grow in 2023 and beyond. For this year, I expect international and North America customer spending growth in the high teens and around 10%, respectively, compared to last year. Despite reduced rig count and completion activity in the U.S., Halliburton's strategy is to deliver a profitable international growth through differentiated technology offerings, selective contract wins, and a unique collaborative approach to working with our customers. Our differentiated technology and digital portfolio deliver high quality and high performance to our customers in all markets. Examples include our drilling and LWD technology platforms, leading-edge drilling equipment, and smart well technology on our e-completions platform. Our value proposition to collaborate and engineer solutions to maximize asset value for our customers and our mainstay processes define how we consistently differentiate our services. This is the source of our competitive advantage. In North America, we delivered a solid quarter with revenue growing 11% versus the same period last year, and margins were sequentially flat versus the last quarter. We deployed additional Zeus fleets on multi-year contracts while retiring additional diesel equipment. Demand for our Zeus E-fleets is strong, and we signed more multi-year Zeus contracts than in any prior quarter. We continue to be impressed by the performance of our Zeus E-fleets and the optimization and efficiencies that come with scale. In D&E, our leading drilling platforms are lower cost and higher performance than the prior generation, which drives higher asset velocity and higher returns. Our strategy also generates strong free cash flow, and our capital return framework returns cash to our shareholders. We retired $1.2 billion of debt, strengthened our balance sheet, twice increased our quarterly dividend, and repurchased approximately $600 million worth of shares. I fully expect that the execution of our strategy in this long-duration upcycle will deliver better returns, more free cash flow, and more cash back to shareholders. Now speaking, Eric Carre, Chief Financial Officer. Good morning and thank you for joining us today. In the second quarter, Halliburton kicked off its SAP S/4 upgrade, which is expected to provide efficiencies, cost savings, and advanced analytics that will benefit Halliburton and our customers. The total project investment should be approximately $250 million, $50 million this year, and $100 million in each of the next 2 years. Upon completion, we expect significant ongoing savings which will pay back the investment in about 3 years. Our second quarter reported net income per diluted share was 68 cents. Excluding the effect of the transaction in Argentina, our adjusted net income per diluted share was 77 cents. Total company revenue for the quarter was $5.8 billion, a 2% sequential increase, while operating income was $1 billion, a sequential increase of 4%. Operating margin for the company was 17.4% in the second quarter, a 329 basis points increase over second quarter of 2022 adjusted operating margin. These results were primarily driven by strong international activity across both divisions, along with improved pricing. In North America, revenue in the second quarter was $2.7 billion, a 2% decrease sequentially. This decline was primarily driven by decreased stimulation activity in U.S. land, partially offset by increased artificial lift activity in U.S. land and higher activity across multiple product service lines in the Gulf of Mexico. Latin America revenue in the second quarter was $994 million, a 9% increase sequentially, resulting from higher completion tool sales in Brazil and improved activity across multiple product service lines in Mexico and Argentina. Europe/Africa revenue in the second quarter was $698 million, a 5% increase sequentially. This improvement was primarily driven by increased fluid services across the region and higher completion tool sales in Angola and Norway. Middle East/Asia revenue in the second quarter was $1.4 billion, a 6% increase sequentially, largely resulting from higher completion tool sales in Saudi Arabia and higher wireline activity, drilling services, and stimulation activity in the region. Our second quarter international revenue increased 7% sequentially due to solid product sales, activity increases, and pricing gains across multiple product lines. Corporate and other expenses was $59 million in the second quarter. For the third quarter, we expect our corporate expenses to increase by about $5 million to $10 million. We spent $13 million or about 1 cent per diluted share on SAP S/4 migration in the second quarter, and for the third quarter, we expect these expenses to be approximately $20 million or about 2 cents per diluted share. Net interest expense for the quarter was $92 million, and for the third quarter, we expect this expense to remain approximately flat. Other net expense for the quarter was $32 million, and for the third quarter, we expect this expense to remain approximately flat. Our effective tax rate for the second quarter came in at approximately 21.3%, and based on our anticipated geographic earnings mix, we expect our third quarter effective tax rate to increase by approximately 50 basis points. Capital expenditures for the second quarter were $303 million, and we anticipate that for the full year, capital expenditure will be approximately 6% of our revenue. Our second quarter cash flow from operations was $1.1 billion and free cash flow was $798 million. We expect to generate free cash flow for the full year 2023, that is 30% to 40% higher than last year. We repurchased $248 million of our common stock during the second quarter. For the third quarter, we anticipate our completion and production division's revenue to be essentially flat with the second quarter and margins to remain approximately flat. In our drilling and evaluation division, we anticipate sequential revenue to increase in the low single digits and margins to increase 25 to 75 basis points. Now speaking, Jeff Miller, Chairman, President, and Chief Executive Officer. Today, I am pleased to report that Halliburton's international business is growing at a strong pace across all regions. We are leveraging our differentiated technology offerings, selective contract wins, and our unique collaborative approach to working with our customers to deliver higher international margins and growth. In North America, our strategy is focused on capital efficiency, differentiated technology, and alignment with high-quality customers. This will allow us to generate solid financial performance and better returns, more free cash flow, and more cash back to shareholders. Barclays analyst David Anderson inquired, could you provide an overview of how you expect North America, Middle East, and offshore markets to trend in the next 12 to 24 months? What is your outlook for NAM spend in the second half of the year? How do you anticipate the ramp-up in the Middle East and offshore markets? Jeff Miller replied, I'm confident in the long-term cycle of our business, particularly due to attractive commodity prices and increased demand for oil. Offshore, we're seeing 50% of our revenues come from international sources. It takes time to get projects underway, but we are beginning to see progress in the Middle East and North America. In North America, commodity markets are becoming more constructive, oil and gas prices are stabilizing, and customers are consolidating and planning for longer-term projects. Service intensity is increasing, and we've seen an uptick in e-fleet contracts that will start in 24 and extend into 25 and 26. All of this points to a strong outlook for Halliburton in 24 and beyond. Barclays analyst David Anderson inquired, Jeff, what trends are you seeing in pricing and pumping for your services? Are Tier 2 and Tier 4 services holding up despite the falling rig count? Can you provide more insight into the competitive pricing environment? Jeff Miller replied, we are transitioning to electric and retiring older equipment. We don't participate in the spot market, but rather focus on large private and public customers. Our performance is improving, even as we add electric, and our diesel fleets are performing well. We are seeing no deflation in the technology and services that drive our margins in high-performing business. J.P. Morgan Chase & Company analyst Arun Jayaram inquired, Jeff, how do spot market conditions affect pricing on dedicated fleets and price negotiations for 2024 in North America? Jeff Miller replied, "We have a bit of exposure to the spot market, but our focus is on delivering high-quality services with our e-fleet rollout. This will provide our clients with better performance at a lower cost, while also reducing our total cost of ownership. We are committed to providing high-quality service and taking care of our surface equipment, as this will have longer-lasting impacts." J.P. Morgan Chase & Company analyst Arun Jayaram inquired, "Jeff, what are your thoughts on offshore markets and how is your product line positioned to mitigate risk in the Gulf of Mexico?" Jeff Miller replied, "We are heavily invested in our offshore business, with all of our service lines participating. We have leading positions in cementing and HCT, and our drilling business is an important part of our strategy. Our offshore international business continues to grow as a percentage of our total business, and we expect the Gulf of Mexico to strengthen. Offshore business is key for Halliburton, both in the Gulf of Mexico and around the world." Evercore IC analyst James West inquired, "Jeff, what is the net increase in horsepower as the Zeus and E-fleet rollouts come to market?" Jeff Miller replied, "It's not an exact science, but generally we replace one piece of equipment with another. We retire higher-cost equipment and use the parts to improve the margins of our existing fleet. We only add new equipment when it is demanded by clients." Jeff Miller replied, "We are building our product to fulfill contracts that require a return of capital and a return on investment. This is what is driving the pace of replacement." Evercore IC analyst James West inquired, "What is the conversation like with customers around pricing for service equipment and products as rigs are mobilizing offshore?" Jeff Miller replied, "We're seeing pricing increase due to tightness in the market, as well as the efficiency and performance of our equipment. We've made significant structural and technical improvements to our drilling business, and we've implemented new wireline processes. In some cases, we don't have the capacity to meet demand, which is driving prices up." Goldman Sachs analyst Neil Mehta inquired, "Jeff, how aggressive do you intend to be with the repurchase program? Is it a radical or opportunistic approach?" Jeff Miller replied, "I can confirm that we are committed to returning at least 50% of our free cash flow back to shareholders. We have a base case for this, but we are able to flex up from that." Eric, do you have anything to add? Eric Carre replied, "I believe our focus is on generating free cash flow and using it to both buy back shares and strengthen our balance sheet. We are currently generating enough free cash flow to do both, with the priority being on buying back shares." Goldman Sachs analyst Neil Mehta inquired, "Eric, what Q3 considerations should investors keep in mind when building their models?" Eric Carre replied, "No, we've already discussed this. As Jeff mentioned, North America will be slightly lower in H2 than H1. Q3 will be down compared to Q2 and Q4 should be flat relative to Q3, taking into account holidays and seasonality. This, combined with our guidance by division, should give you a good idea of what to expect for the rest of the year." Citi analyst Scott Gruber inquired, "Jeff, what are clients saying about their plans for gas completion activity in the second half of this year?" Jeff Miller replied, "I'm confident that the outlook for 2024 is consistent with what we've seen in the market. We don't have a precise date, but there's no doubt that gas is strengthening and LNG takeaway will be active. Oil prices are also quite favorable, which could bring some smaller players back into the market. All of these factors point to an improving market cycle between now and 2024. Citi analyst Scott Gruber inquired, "What is the conversation with customers regarding well productivity in the U.S. and the need to drill more wells?" Jeff Miller replied, "No, I don't think it's possible to produce the same results over time without efficiency or insight improvements. Our Smart Fleet offering is part of our technology portfolio to help customers better understand rock productivity and frac design for increased productivity. North America saw a rapid decline in activity during COVID, which is well understood by the market and our clients. To move forward in North America, e-fleets are essential to help clients achieve better productivity and lower costs. That's why we're so focused on that." Piper Sandler analyst Luke Lemoyne inquired, "Jeff, what are your expectations for North America margins for the remainder of the year?" Piper Sandler analyst Luke Lemoyne inquired, "Eric, what drove the improvement in 2Q D&E margins compared to your expectations?" Eric Carre replied, "Yes, I believe our D&E margins improved due to better execution across product lines and regions." Stifel Financial Corporation analyst Stephen Gengaro inquired, "Can you provide an update on pricing dynamics in the U.S. frac business since consolidation and better behavior by industry players?" Jeff Miller replied, "The key difference between our current e-fleet and what we've seen in the past is the type of equipment we are now offering. Customers are responding positively to this new technology, and it's having a meaningful impact on our performance. We have always invested in our equipment and technology, but now there is an understanding that it can't be run to the ground and then rebuilt. This is a shift from the past." Stifel Financial Corporation analyst Stephen Gengaro inquired, "How do you think the curation of well quality impacts your completion business?" Jeff Miller replied, "Yes, Halliburton is well positioned to benefit from the increased demand for technology and services in the oil and gas industry. We are confident that North America will continue to be a major contributor to the global supply of oil and gas, and this will require significant investment in technology and services. We are confident that Halliburton is well prepared to meet this demand. Cohen and Company analyst Mark Bianchi inquired, could you provide an outlook for Halliburton's EPS in the fourth quarter compared to the third quarter? Jeff Miller replied, yes, our outlook for Q4 remains unchanged. We are confident that our plans and strategies are on track and will. Cohen and Company analyst Mark Bianchi inquired, is the mid-80s of a negative number and $20 million to $25 million run rate beyond third quarter the right way to think about the software impact? Eric Carre replied, we guided corporate to be $5 million to $10 million up from Q2, which is a timing issue. SAP was guided separately at $20 million or 2 cents for the quarter. We'll provide yearly guidance of $50 million this year, $100 million next year, and $100 million the following year, with more color on a quarter-to-quarter basis depending on the rollout. The Benchmark Company analyst Kurt Halliburton inquired, Jeff, what trends are you seeing in international activity, particularly in the Middle East and Latin America, relative to the beginning of the year? Are there any signs of increased urgency or acceleration in projects? Jeff Miller replied, OPEC cuts have no bearing on our activity. We are seeing steady growth in our business, which is consistent with the long-term nature of this cycle. We don't anticipate any sudden spikes or drops in activity, but rather a gradual increase as big projects get underway. This is a great setup for Halliburton, and we expect the cycle to last for some time as barrels are invested in and reinvested. The Benchmark Company analyst Kurt Halliburton inquired, how can Halliburton continue to outpace the market in North America despite flat growth? Jeff Miller replied, I believe that e-fleet and service intensity will be in high demand for Halliburton in the future. We are uniquely positioned to capitalize on these opportunities, as our services are already in high demand. We are confident that our focus on technology and service intensity will continue to be beneficial for us in the long term. Jeff Miller replied, thank you all for joining today's call. Halliburton had a strong first half of 2023, and I'm confident that our strategy will continue to deliver improved returns, increased free cash flow, and more cash to shareholders. I look forward to speaking with you again next quarter.